In this video, we'll explain what the repo rate is and how changes in it impact the economy, bank loans, and fixed deposits. We will also talk about when and why the RBI changes the repo rate as part of its monetary policy and how these changes affect everyday life, like the cost of taking a loan or the interest you earn on savings and fixed deposits. We've already talked about the Reserve Bank of India, RBI, how it was established, and its role in the Indian economy. Don't forget to check out the other videos in this playlist for more insights. Now, let's discuss the repo rate, a key concept in banking sector that directly affects our daily lives, including loan interest rates and savings returns. The repo rate is the interest rate at which the Reserve Bank of India, RBI, lends money to private or public sector banks and other eligible banking institutions when they face a shortfall in funds. A bank may need funds from the RBI to manage short-term cash flow needs that may arise due to high loan demand that exceeds available deposits or handle large withdrawals by its customers that create temporary liquidity gaps. When the RBI changes the repo rate, it directly impacts loan costs. A lower repo rate makes loans more affordable, encouraging people to spend on big purchases like cars, homes, and consumer goods such as TVs and air conditioners, which boosts sales and economic activity. However, a lower repo rate also reduces interest rates on fixed deposits, FDs, and savings accounts, prompting people to look for alternative investment options like stock market to get better returns. A higher repo rate makes loans more expensive, which can discourage spending on purchases like automobiles, homes and other consumer goods like TV, air conditioner and more. This helps to slow down demand, which in turn can help to keep inflation in check. At the same time, a higher repo rate also leads to higher interest rates on fixed deposits and savings accounts, making saving more rewarding and encouraging people to deposit money rather than spend. The RBI doesn't change repo rates randomly, it carefully adjusts them by looking at key things like inflation, rising prices, economic growth, currency value, and other important key economic factors to keep the economy stable and running smoothly. The RBI reviews the repo rate during its Monetary Policy Committee meetings to decide if changes are needed. Adjusting the repo rate helps the RBI control inflation and support economic growth as part of its monetary policy. We will explain RBI's monetary policy in detail in a separate video. Now that we have talked briefly about the repo rate and its impact in the Indian economy, it's time to explore some other important banking concepts in detail. In the upcoming videos, we will simplify and explain important banking concepts like reverse repo rate, cash reserve ratio, CRR, statutory liquidity ratio, SLR, RBI's monetary policy, and other banking concepts in an easy-to-understand way to help you grasp them better. Don't forget to check out the other videos in this playlist for more easy-to-understand details.